You might look at a commercial deal and see a flawless asset, but relying on free, commission-funded broker advice is a highly effective way to let hidden risks fracture your capital from the inside out. Many new and active investors cross over from residential real estate carrying a dangerous assumption. They expect a built-in regulatory safety net to catch them if a deal goes sour. In the commercial sector, courts presume all parties are sophisticated actors. Those mandatory disclosure requirements, strict fiduciary standards, and cooling-off periods that protect consumer homebuyers simply do not apply here. This regulatory vacuum means the burden of due diligence drops entirely onto your shoulders. There is no legal mechanism assuming you need protection. This environment means the transition to commercial is only as safe as the underwriting behind it. Without a rigorous framework to replace those missing legal protections, an investor effectively assumes every liability a seller fails to disclose. Market volatility is a known risk. A quieter, more devastating threat to your portfolio is a structural flaw we call the economics of omission. This flowchart maps out traditional broker compensation. An investor's capital flows into the property purchase, and only when that transaction successfully closes does it trigger a massive payout for the broker's commission. But watch what happens if that same broker advises you to walk away from a risky deal. The connection severs. Their revenue instantly drops to zero. As an investor, your requirement is to protect and grow your capital over a 5, 10, or 15-year hold. The broker's financial incentive is entirely based on their speed to close. This severe misalignment ensures due diligence gets compressed. Critical financial risks are omitted from the conversation by design, not by individual malice. This is a standard offering memorandum. While the marketing highlights the upside, these documents frequently omit the specific liabilities that dictate long-term performance. The first trap is hidden deferred maintenance. Aging commercial assets carry hefty capital expenditure obligations, like HVAC units or roofing systems nearing the end of their lifespan, that are rarely modeled into the initial cost to protect the closing timeline. This chart shows what happens next. You lock in what looks like a strong initial cap rate on day one, but 18 months later, surprise capital calls crush your projected yield. The second trap is inflated net operating income. To make year-one projections look better than reality, brokers bake in highly optimistic rent growth and understate actual operating expenses. Notice this sudden drop in year 4 of the hold. That represents lease rollover risk, mid-hold tenant exits in retail and office spaces that were entirely omitted from those rosy initial projections. The final trap involves the sheer complexity of underwriting. Properly vetting an asset requires modeling debt structures, rate caps, and zoning risks, variables that commissioned brokers will not slow down to analyze for you. Individually, a missed roof replacement or an ignored lease expiration looks like an unfortunate oversight. Collectively, they are the exact mathematical output you should expect from an advisory model built on speed. To get genuinely unbiased investment advice, you have to sever the connection between the advisor's paycheck and the closing table. This is the core structural principle at PRI Consulting. Under a flat-fee advisory model, you pay exclusively for analytical truth, not for access to a broker's inventory. Removing the pressure to close frees our team to apply strict institutional-grade underwriting logic to every opportunity, whether you are acquiring a multifamily property or structuring a complex hospitality conversion. Because the fee is fixed the moment we engage, advising you to kill a terrible deal is exactly as profitable for us as recommending you proceed. Removing that commission incentive changes the nature of the partnership. The advisor acts as a filter, applying the same level of scrutiny an institutional acquisitions team uses to protect your capital from poorly structured deals. This interface gives you direct access to the same tools our advisors use. You can start building this level of institutional competency right now, even without a paid consultation. Active investors can take our free commercial real estate masterclass or dive into the underwriting vault to start running their own numbers safely. If you are actively evaluating a specific deal or scaling your portfolio, your next step is a free capital audit, a personalized, zero-obligation tool designed to stress test your strategy. Click the link below to get your free personalized investment action plan. We'll also give you access to our interactive cap rate calculator, so you can instantly spot the hidden risks before you deploy a single dollar.